Good afternoon and welcome to our very first webinar of 2022. In today's session, I'm joined by the OmniPro team, Naomi, Colin, Lindsay and Sinead, and we're looking at, well, what are the hot topics for 2022? So thank you so much for joining us on this free three-part webinar series. It's hard to believe, it's the 13th of January. You know, and we've come from the end of year rush in terms of the CPD Fest, the Essential Advisors Mix, and you know, we took a break over Christmas. We're coming to terms with coronavirus, so it obviously hasn't gone away. It's still here. It's still having an impact. You know, we're back in the office last week and we're talking about, well, what do the accountants need next? What do the accountants want next? Obviously, we've pre-planned our 2022 program, but it just never stops. It just never stops. The changes just never stop. And our technical team is growing. You see, Elaine has joined us here. Our technical team is growing and growing and growing, and we are struggling to keep up. How can you be expected to keep up? How can you be expected to keep up? The challenges of coronavirus, the challenges of Brexit. Now, this is the first part of a three-part series. So this is looking at the hot topics for 2022, down and dirty, what's happening for accountants in practice, what are the issues that are happening right now. And the second part of the series, which is on next Tuesday, is Brendan Casey. And Brendan is looking at changes in the welfare state pension and an update on the qualification requirements of the state pension. Critical, a serious issue. Somebody like Brendan going deep, clearly a category authority. The third part of the webinar series is Andrew Agnew and Kieran McGonigley. And the guys are looking here at customs in the post-Brexit trading, because as we know, Brexit has happened, but it's still happening, it's still evolving, there's more things landing, it's getting harder and harder. And again, category authorities on that topic. Our internal team here are fielding the practical questions on a day-to-day basis. We know that it's hard and challenging because there's some CPD out in the marketplace and it's up here. It's up here at this high level. But we need CPD at all levels. We need CPD that is practical. Maybe you're an expert in tax, but maybe financial reporting is not your thing. Maybe financial reporting is your thing, but you need to get the fundamentals on tax. And what our internal team here do, and we do this for our CPD Club members, every month we do an exclusive CPD Club update that's just for members, where our team are taking literally the questions that are being asked today, the stuff that's happening right now, the real-time stuff that helps keep you practically up to date. Okay, so that's the introduction. Just in terms of housekeeping, obviously to welcome you all here, we've got over 600 on today's session. I think there may have been a couple of latecomers there, so maybe if we just put the link up into the chat box. The notes for today's session are in the chat box. So if you want to go into the chat box and download the notes pack for today's session, the slides and the supporting material that goes with what we're covering today, down into the chat box. Obviously in the chat box, look, coronavirus has changed how education happens, how CPD happens. Into the chat box, discuss, chat, interact. If you have questions, please put the questions into the questions and answers box. And we don't have all the answers. We spend our lifetime looking for all the answers, but we don't have them all. So put the questions, your questions into the questions answers box. Hopefully we can answer them. The entire team has the questions over here on a second screen. So put your questions, if you have any, into the questions and answers box. We'll answer them as we go through, or we'll answer them at the end of the individual segments if necessary. I've said to you about the notes. Download the link. And for everybody who attends live and is on here on the webinar with us, complying with the requirements, we will be issuing accredited CPD certificates within 48 hours. Now, if you haven't already booked for part 2 and part 3 of this series, we have a link there on screen. You can see all of our course listings for the year by date. And this year, we have a fairly ambitious program in that I think we have over 100 webinars, live webinars like this. We have 12 exclusive CPD Club members updates, plus we have over 32 days of conferences giving you a massive choice of CPD. Okay, so I'm now going to, who we have talking today is, first of all, we have Lindsay. This is just some of our new internal technical team. And Lindsay is going to cover off from a financial reporting perspective. And Naomi is going to look at from just the COVID wage subsidy updates. Colin is going to look at some new and exciting quality control material for auditors. And Sinead is going to cover off here on company law. So my introduction now is coming to an end. We're going to hand over to the teaching space. We're going to spend 45 to 50 minutes on teaching and questions and answers, and then we're going to close it down. Our session today will end at 12:30 for those of you who are up against the clock. And sure, as we all know, as accountants, we're always up against the clock. Lindsay, I'll hand it over to you.
Perfect. Thanks very much, Des. So we're going to have a look at financial reporting and auditing in 2022. And really, we're looking at the ongoing impact of COVID-19 and Brexit. So I think we all thought and hoped that we would be beyond talking about COVID-19 by now, but we are still in the thick of it. And we need to keep that in mind for our 2021 year ends. The impact of COVID-19 and Brexit is very uneven across different industries and across different clients. So some industries like hospitality, the travel industry, seeing much more impact from COVID-19 and from Brexit than other industries. And we need to be aware of this, and we need to be tailoring the disclosures to the particular clients, to the particular companies we're working with. So if we first have a look at the impact on the financial statements, the primary sections that are impacted are the director's report, impairments in fair value, going concern, post-balance sheet events, and significant judgments and estimates. So we'll have a look at those in a little bit more detail on the next few slides. So if we have a look at the director's report first, and I just want to re-emphasize, I know I say this every time I talk about the director's report, it is the director's report. It should be the directors that are having the influence and the say in terms of what goes into that report. I know in practice we draft that report for the directors, but it's really important that they do have some say in what goes into that. They're not just signing off on what we've drafted.
And all we're really looking for here, folks, is some sort of dialogue of, this is the circumstances, this is what we see as the issues, this is our suggested wording, is our understanding of your circumstances correct? Do you have anything else you want to add? Now, obviously, you're going to have to keep them safe that they don't start putting in crazy shit, but, it's to at least have them having an input into what the director's report is. You see, okay, so here's the reality. The reality is, 98% of companies probably aren't going to have an issue, but and huge numbers of your companies, the small husband and wife companies where really they're self-employed rather than business owners, this isn't going to have a huge impact. But it's for those few that it matters. It really matters. And let's be honest. We're in this booming economy, but it's a two-tier economy. And let's be honest, there's zombie companies out there all over the place. There's businesses that are just surviving on subsidies. This party has to come to an end. So in this year, this is really going to happen. And we had historically low insolvency events over the last 2 years. Insolvency is going to come back on, and not only insolvency, but there's going to be extreme hardship on the horizon for certain businesses and certain sectors in certain geographic areas in the next 2 years.
So the first section we'll have a look at in terms of the director's report is the review of the business. And in terms of section 327, the entity should give a fair review of the business. And that's obviously going to be impacted by COVID-19 and by Brexit in those industries that are impacted. The next section that it could be impacted is principal risks and uncertainties. And both of these two first paragraphs are only really applicable for medium and large companies. They're not required for Section 1A companies. But when we are disclosing principal risks and uncertainties, we need to think about Brexit-19. We need to think about, COVID-19 and Brexit. We need to try and avoid boilerplate disclosures. So you need to really think about what are the principal risks and uncertainties that are affecting that company. How is that company affected by these risks, and what are they doing to mitigate those risks? So we really want to make it specific and tailor it for the company and avoid those boilerplate disclosures. It can be quite tricky. Some of the risks can feel very generic. For example, credit risk. Any company that has debtors has credit risk. But you need to think about, well, who are those debtors? How is that company impacted by credit risk? And what are they doing to mitigate the credit risk? So you do need to tailor it. The next two sections are relevant for all sizes of companies. So where you have subsequent events, those need to be disclosed in the financial statements, in the director's report. And obviously, we were only, on the 13th of January. So for your December 21 year ends, we don't have a lot of information yet. But hopefully now, in 3 months' time, everything will have opened up, the restrictions will have gone, pubs and restaurants will be open, and we'll be able to put that in the subsequent events for those types of companies, that they are back to trading, hopefully. There's no guarantees. For going concern,
just in case anybody's getting worried, folks, that was a Freudian slip by Lindsay. The insanity of Brexit has not blended with COVID virus to create COVID, or to create Brexit-19, right? So still, Brexit is still mad, COVID is still a little bit mad, but they're still two separate things despite Lindsay mashing them together there.
They're one thing in my head, but it's definitely just in my head. Going concern, obviously a huge issue. And if there is a going concern issue, it does need to be disclosed in the director's report. And we need to just be cognizant of what we're disclosing in the director's report needs to be very much in line with what we're disclosing in the financial statements. So just making sure that any message around going concern is consistent between the two documents. The easiest way to do it is simply to copy and paste between the two documents. So if we have a look at the notes to the financial statements, then fair values and impairments is one section that's going to be impacted. And most of these are really affected by the current economic volatility and the uncertainty we face. And that's due to COVID-19, that's due to Brexit. But there's also climate change. There's also, the increasing pace of technological change. So there really is a lot of change going on. And that makes everything we try to do when we're looking at the future, when we're having estimates, when there are assumptions about the future, it makes all of that so much more difficult. So when you are thinking about fair values, when you are looking at impairment reviews, make sure that you are using the latest data, the latest assumptions. Things change so quickly that if you're using information from a month ago, it could well be out of date. So always make sure we really are using the latest information, the latest assumptions, and that you're keeping up to date with what's going on in the market and how the economy is tracking.
And you see, okay, so a couple of things here, right? First of all, on the director's report, Lindsay was talking about, well, some of this stuff is not relevant to small companies. We can exempt ourselves out under Section 1A FRS 102. But things like principal risks and uncertainties, if they're contentious, we should actually consider, should they be included, even from a note disclosure perspective, and then a director's report perspective, even for audit exempt smaller companies. But there's no exemption here from fair value and impairments, going concern and post-balance sheet events, what Lindsay has on here. This is all companies. And you see, the point is, it's not just COVID, and it's not just Brexit, it's business has changed, and business is changing, and certain business sectors are under pressure. If they haven't moved during this time to online trading and online and integrating into the new way that business works, we can have fair value and impairments. It's not just one size fits all. Well, sure, we're in a booming property market, we're in a booming everything else. No, some sectors and some businesses are decimated in this area.
Yeah, absolutely. the amount of change that we're going through at the moment is just, it's incredible. And it makes our job so much more difficult when we're looking at things like this. And going concern is the next one on my list there. And that, again, is so much more difficult when we're trying to look at 12 months into the future. We just don't know what that's going to look like. So we're using our best estimates and best assumptions. And again, we need to make sure that we're using the latest information there. Things change so quickly. When we're talking about going concern, again, we need to think about appropriate disclosure. So making sure it's in the director's report, making sure it's in the notes to the financial statements. It usually comes under the basis for preparation note. It can also be included in the judgments and estimates note. And also always remember the interaction between going concern and the post-balance sheet events note. Often those are tied together, especially for things like COVID-19 and Brexit. Those type of events really deal with both notes. So it's important just to consider all that disclosure. And again, just making sure that we're being consistent throughout the documents in our messaging around those issues. Obviously, the next note there, post-balance sheet events. So hopefully we'll have good news for people, but we'll have to wait and see now. And then the last section in the notes to the financial statements that has a huge impact from Brexit and COVID-19 is significant judgments and estimates. And again, this is because of the uncertainty we're facing. When we're thinking about estimates, we're looking to the future. We're trying to estimate how many of our debtors are not going to be able to pay us back. And we just don't know, because we might have some debtors that are pubs. We don't know when they're going to be able to reopen and trade beyond 8 o'clock. So we don't know how their cash flow situation is, how quickly they're going to be able to recover. So there's a lot of judgment, there's a lot of uncertainty here, and we need to make sure we're aware of that and thinking about it, and trying to use the latest information we can for all of these things. So if we have a look now at the audit file and the impact of COVID-19 and Brexit on the audit file, from a planning perspective, we're really looking at what are the additional risks that are created, or what risks are made more risky or made more important because of COVID-19 and Brexit. We need to think about things like the hospitality industry. We need to think about where we have a client that serves the hospitality industry. So we really need to be looking at our risk assessment, particularly around going concern. What are the issues here? What are the areas? That's quite important. From a fieldwork perspective, we're really looking at all of those contentious areas we just spoke about in the financial statements, making sure that we are documenting all of our thought processes and all of our decisions and all of our information, making sure that that's all being documented. I think often auditors have a lot of information because we might audit several companies in the same industry. We have a lot of information, we have a lot of judgment, we have a lot of experience, but we're not very good at actually documenting our thought process, documenting our decision-making processes. So making sure that where we are looking at these more contentious issues like fair values, like impairments, like estimates, that we're documenting that really well, that we're putting in all the information we have. And then in terms of completion, the main issues there are really going to be around post-balance sheet events and going concern. Again, it's really around the documentation of these issues, making sure that that our thought process and our decision-making process is well documented and is written down and supported by the information. So that's really important. And then obviously disclosure checklists. So making sure that where we have to disclose issues around going concern, we've done that, and we've done it in all the right places. Where there are post-balance sheet events, they've been disclosed, and our disclosure is appropriate. It gives the users all of the required information that they need.
And just as Lindsay is finishing off, before we come on to Colin, and he's going to talk about the wonder of the new Irish quality management standards. And one thing to remember from an auditing perspective, a very simple thing, but a practical thing that we've come across, how we do audits in 2020 and 2021 has changed. Because people are remote working, Financial controllers are remote working. Clients don't want us in our office. Our team is not going into the office. So audits have changed. Now, the reality is that irrespective, like apparently Omicron, apparently we've turned the corner. We're now dropping. We're plummeting like a stone in terms of Omicron, that we look like we've turned the corner on this. We're not going to be back in client offices in the next 2 to 3 months. It's just not going to happen. So in your audits, don't miss out on the fundamentals. Lindsay's talking about, you've heard it before, if you've heard anything about auditing, documentation. But how have things changed? How has your audit changed? And how are you taking account of coronavirus? We can't just ignore the fact that the physical circumstances are different. Lindsay, do you have any final point?
I have one final point, and that's just around making sure that we're challenging management's assumptions. So when we're looking at all of these contentious issues, particularly around going concern, that we are challenging management's assumptions, that we're not just believing them. I think sometimes, and I know I'm guilty of this, I like to believe the best in everybody and think that everybody's going to tell me the truth and everything's going to be fine. But we really need to make sure we are challenging management's assumptions and documenting how we're doing that, and the information that we've got.
And I think that can be a difficult thing to get down on paper. I think and we're seeing it now. That's been driven by ISA 540 and accounting estimates, and you can see that now is being picked up a lot more on monitoring visits. Explain or show how you've challenged management, and it can be quite difficult. It's a big change, actually. So what's happened now is the old ISQC1. That's gone now. It's been replaced by two standards, ISQM1 and ISQM2, and then they've obviously updated ISA 220 because of the changes. What they've done really is ISQM1 is very similar, almost exactly the same as the old ISQC1. But what they've done is they've spun out anything to do with engagement quality control review, as a hot file review, into its own individual standard, and it just emphasizes the importance that the standard setters are putting on the whole area of engagement quality control review or a hot file review. So as I said, it's been issued, and it's been issued by IASA back in December 2021. So quite literally, I think the last week in the working year, they finished their consultation, and they basically issued. So it's going to be it's now replacing the current control standards, which is ISQC1. Important things here now. So effective dates of the new standards, 15th of December 2022. So ISQM2 and ISA 220 is effective for periods beginning on or after the 15th of December 2022. An important point on ISQM1, so that kind of first document, the quality control document, while it's effective on the 15th of December 2022, you need to have it in place by the 15th of December 2022. So you can't wait until afterwards, because you're going to have to evaluate this new system within 12 months of 15th of December 2022. So again, it's a really important. So you'll be looking to kind of starting to put this in place in the back end of this year. Have it done, have it ready, because you're going to have to evaluate it as you go along. Where's the evaluation going to come along? It's going to come along as part of your monitoring process, as part of your ACR, that kind of stuff. Why are we doing this? Well, really, it's changing the focus. It's changing the focus from a kind of a reactive to a proactive approach, identifying the risks and responding to the risks, the quality. You're looking to. It's forcing you now to really tailor your control, your ISQM document for your firm based on the risk, the type of clients you're doing, the type of audits you're doing. So it's focusing on you to sit down and kind of really discuss and form that basis based on the nature and the circumstances of the audits you're performing. So it's a change in the mindset. So
Colm, I'm sorry now to break your stride, but just
go on.
But just to ask the question, right? The effective date for these new standards is 15th of December 2022. Okay. Now the FRC, IASA, they vary sometimes when they introduce this for periods ending on or after, or periods commencing on or after. So this is effective date 15th of December 2022. This is for periods beginning on or after 15th of December 2022. So if we take a 31st of December year end, that's going to be our 31st of December 2023 year ends. So am I right in saying we do have a 24-month run into this, or am I misreading?
No, you do only for ISQM2, so the hot file review one, and ISA 220. Which is the engagement control. The ISQM1 is slightly different. You have to have it in place by the 15th of December 2022 because you have to evaluate it 12 months after that date. So there's slightly subtle dates in it.
Okay, yeah, but this is, you see, Colin, so what they've done is they've literally come out and explicitly said, right, ISQC1 manual on your bike, ISQM1, which is your new manual, they're now telling, look, you need to have that in place by December 2022, so you can apply it by December 2023.
Yeah,
so
exactly.
They're literally telling us.
Yeah, because it becomes effective after the 15th of December, but you got to have it in place because you have to evaluate it. And the whole idea of this basically is now, look, let's get to the brass tacks here. It's not, the vast majority of firms on this call, it's not really going to have a fundamental difference, a fundamental change, because I'm going to say, I'm going to move on to ISQM and one. It's going to be very, very similar to what you already have. Like, as in, ISQM1 is going to be very similar to ISQC1. It's going to have the same paragraphs, the same requirements. But the key thing basically is it's moving from a compliance-based or a reactive-based to a proactive-based and a risk-based. We're going to land, the vast majority of firms on this call, we're going to land on the exact same places where we would have landed with ISQC1. But we're going to have to go through the process. We're going to have to, tailor it appropriately. Have a look at your client base. How risky are we? How are we approaching our risk-based? How are we managing risk? It's another, as you, Des, always says, it's another something to strangle the pearl auditing firm. It is, and again, it's going, at least the components there. My third point there, the components are very similar to what's going to be there in your existing policy and procedure. But you're going to have to sit down. You're going to have to establish your quality objectives. You're going to have to identify and assess the quality risks, and then you're going to implement responses to those risks. How are you going to do that? You're going to do that it's going to be based on your ACR. There'll be a lot more emphasis put on that, on monitoring, on how you're monitoring risk. Well, how do you monitor risk? Well, you monitor risk by your annual compliance reviews, your whole firm reviews, your cold file reviews. You get us on board. That's how you're doing it, and then you're going to be documenting and assessing how we appropriately done it.
So, Colin, so the vast majority of our audience is SME firms, right? So we've got multi-partner firms, but we're not talking to the big four on this webinar. So for everybody, the solution here is ISQC1 is going to be replaced. I know Elaine and yourself, Elaine is sort of our queen of the arc. So Elaine is updating the Accountants Resource Centre. So I know Elaine and yourself are already working on what does an ISQM manual look like as opposed to an ISQC1 manual. So we are going to give you the processes, the procedures, the methodology. But even when we give you those processes, procedures, and methodology, there's a higher standard, there's more work, there's more documentation, and we're trying to minimize this, right? So this is early, it's early, right? But we're trying to minimize this, but there is a step up here from ISQC1. So we'll produce, any of you who are ARC members, we will produce the ISQM manual for you, but you're going to have to apply it, and everybody's going to have to take a step up. Now, there's just a clarifying question there.
And like I said, like Des, you made a very good point. Like the vast majority of firms on this call, it's not really gonna. There is going to be a lot more work, but it's not going to be a massive change in where you land. It's not going to make a difference to their audit opinions, Colin. Well, it's actually not going to make a shit of a difference anywhere. It's just more paperwork. I've been talking to people in big four firms and say top 10 firms. They're setting up departments to manage this. This is how serious they're taking this. This is how serious this is going to be. They're setting up departments. They're setting up teams to actually go out and manage it. How they're managing it. They're managing by doing file reviews. They're managing by doing internal risk assessments. So it's a massive for those firms, and maybe the odd firm on this call now, Des, if they've got the risky kind of clients, their client profiles, it could be a bit more.
Absolutely. You know, if you've got the risky clients, you might only be a 2-3 partner firm, and I say only because it's only in comparison to the big four, which this is really directed at. But that's going to hit you guys harder than people who have the bog standard audits. Now, some questions in reverse order column. Jane, this is for audit firms only. Absolutely, this is just for audit firms.
Yeah, audit firms only.
Ben, I assume the IES 8 will need to be further tied based on the ISQM 1 assessment. Absolutely, and they've tightened up. They've tightened up separately, Ben. Totally tightened up separately in terms of audit requirements for CPD. So there's a whole new requirement there for you. And unfortunately, Ben, that's not coming at the end of 2022, or that's not coming in 2023. The new requirement in relation to audit CPD is happening right now. But you see, the whole concept, what are they trying to achieve here, right? We've got this framework of the auditing standards. We've got this requirement under the Code of Ethics to be competent. We've got IES 7 and IES 8 in terms of educational standards. Now we've got the auditing standards in the middle. What ISQM is doing is it's the practical application and safeguard and controls of pulling all of this together. So Colin, can you just talk for 30 seconds on the new requirements for any auditors who are on with us in terms of what they need to do in CPD in 2022?
Right, basically, okay, so anyone on this one, jump on, get on to the next monthly update at the end of the month. I'm doing a 10-minute session, but 30 seconds basically is you've now got to demonstrate how you are competent with both within an Irish jurisdiction, and unluckily enough, if you're a UK auditor or if you've got dual registration, as they call it, and you've got a UK license as well, you've got to demonstrate for the UK. So we're looking at the financial reporting framework, the auditing framework, on IASA laws, the legislation and European law. You got to demonstrate what you've done. It ties in. It's gone away from just give me a list of your CPD lads. No, that's gone. It's tying it into planning, doing, reflection. It's proactive. It's not just saying I'm going to do it. Sure, I'll pick these ones out. How can I tie it into my list of my clients? It's areas, what they call areas of relevance. And that's the big thing. So if you look down your list of all clients, you got of a credit union, of an IB entity, of a charity, you've got to have CPD, credit union CPD, IB entity, all that kind of stuff. So it really is a lot more involved.
And like if you look at it, we actually, I don't know, there was 8 or 9 of us were on a meeting about just, we were talking about audit CPD only the other day, and how audit CPD and how that interacts with, yes, hardcore auditing CPD. How are we going to build a program for you guys? So basically what we're doing is we're mapping out, okay, if we've got our standard small sole practitioner who does audits, what do they need to do from an audit CPD? Part of what we're doing this year is we're creating a pathway for you to do that CPD. Bigger firms, what does their CPD look like? Now, how does audit CPD tie in with tax? How does audit CPD tie in with financial reporting? How does audit CPD tie in with company law? So basically what we're trying to do is to take the thinking out of this for you, is to create pathways where, look, if you're an auditor with this type of clients, you do this CPD, you're covered. And so we're trying to, and we're building a process to help you plan and map your CPD within this new requirement. Okay, I want to keep moving. There's another question in here. Is ISQM1 effective for the year ending December 2022 rather than 2023, as mentioned, also early adoption? The answer to that question, Sean, is you've got to get your ISQM1 manual in place by December 2022. However, the application of that manual and the requirement to do the reviews and the requirement to look at your changed engagement quality control review procedures, that kicks out to 2023. So it's a 2-step process. Manual procedures in place and then full application and integration. And also early adoption. Sean. We're Irish. We don't early adopt anything. No, in this case, Sean, yeah, usually there's early adoption provisions. I don't think there is early adoption provisions here, Colin, is there? And but Sean,
like in terms of ISQM2 and ISA 220 revised, you can early adopt, but like there's no point in early adopting ISQM2 and ISA 220 if you haven't adopted ISQM1. I'm getting confused with ones and twos, but again, so yeah, like, you know, a big four maybe will be early adopting because they like to be proactive. Very quickly on just ISQM2, it's all about the EQR, so EQCR, engagement quality control review, your hot file review. It's doubling down on the importance that is being placed on it. It really is emphasizing how important a hot file and EQCR is. It's funny enough, it's saying, you know, it strengthens the eligibility criteria. You know, you have to document their competence, the capabilities, including sufficient time. I thought was an interesting point, and the authority to do it. There's no point in giving your hot file review to a junior in the office. They've no authority. So it really is doubling down on that. It's bringing in a whole layer of the stand back approach. Where have we seen this? If you've been on the other workshop with myself and Lindsay and Elaine, you've seen it under going concern. You see it under the new fraud. You see it under the new 315. You see it under ISA 540 and accounting estimates. All of it stand back. The whole wood for the tree syndrome. You've gone off and done it. You've got to stand back and say, does it actually make sense? And have I complied with it in total? So again, it really is putting a lot more emphasis on that. Obviously, most firms here will come to us for an EQCR, but if you're doing it internally, you've got to make sure it's robust and objective. So important points there.
Multi-partner firms, right? Multi-partner firms can conceivably do robust EQCRs. Unfortunately, due to changes here and in ISA 220, sole practitioner firms really can't. Really can't. It's very hard to justify how a sole practitioner firm can do an EQCR. And last words on ISQM, Colin.
Yeah, look, it's going to be a procedural and a process more so than anything else. We're probably going to land, most firms are going to probably land exactly where they've landed at the moment. But again, you've got to go through the process. You've got to, and it'll be interesting to see how the institutes, obviously there'll be a lot more information coming out from the institutes about how they're going to apply this and practice it. Like this is coming directly from IASA. So it'll be interesting to see how their take on it and how and then from our point of view, how the reviewers are going to take this, how they're going to assess it. But again, we've got 18 months before we really see any kind of uptake. But like, just bear in mind. And then the last point here, ISA 220, really focusing on engagement partners and RIs. Again, doubling down on your involvement in the planning, the fieldwork completion. You've got to be involved in it. You can't just delegate to your manager or your director. You've got to be involved in it. It's recognizing the expanded team. If you've got a team out, people outside your immediate team, they're brought into the stable as well. So that's kind of basically it.
Okay, thank you very much, Colin. Next up is Naomi. Just to introduce Naomi, Naomi's a new team member. Naomi comes from a tax background. Naomi's area of expertise is in the whole area of income tax. That's her, she just loves her income tax, but she covers the full gambit of taxes. Naomi she has a passion for education, and she is a student lecturer, as well as being here with us as part of our technical and CPD store team. Naomi, you're going to be talking here about the employment wage subsidy scheme, which is just rolling.
Yeah, they're all rolling. I mean, thankfully, they're not as bad as what they were. I mean, the updates aren't coming as thick as fast as they used to be when it all first kicked off. So basically, I'm just going to briefly go over EWSS, the CRSS, the BRSS. Colloquially in my office, they used to be called the SS groups, and they just never ended. So EWSS replaced TWSS back in September 2020. It was supposed to be short-term measure like TWSS, but it's been extended now until the end of April this year. And you do have until the 15th of January to apply. So basically to the end of this week, if you haven't already done so. Do remember, your tax clearance certainly needs to be kept up to date. So you need to ensure that your filing is all maintained. Regards to the payments, you got your debt warehouse in there, but make sure your filing your paperwork is going in. For re-entry, you can do it, okay? So if you came off the EWSS after the restrictions eased there sort of the middle of summer and you managed to do a booming business and then the restrictions hit again, you can actually reapply. So, it's going back to looking at your averages again. So if the trade exists at 31 December and you had previously correctly availed of the EWSS and there's a 30% reduction in your turnover for December and January compared to the same months in 2019, 2020, well then reapply, go for it. Now at the end of January, you are going to have to do a review again, but you know what? It's go for it. Like it's there, utilize it. And then for new startups, you take the average for January and compare them for the averages up to December 2021. So if you're somebody who only came into business at the start of towards the end of 2021, and then you get hit with the lockdown, go have a look at your averages, see if you apply there, especially for the likes of the hospitality sector, anyone who works late nights, this is probably still there available for you. The one thing to note about the EWSS is the rates did increase at the start of November, but now at the end of January, they're going to go back down again. So just be mindful of that when you're covering people's wage bills, is the amount of money you're getting in is going to drop back down. And for March and April, they really are dropping back down. And the good thing about EWSS, though, is the normal PRSI Class A rates apply for employees, but employer PRSI rates will reduce from the 8.8 to the 11.05% down to 0.5%. And that's great because it means that the employees' entitlement to state benefits will remain intact going forward. Not like under the TWSS where PRSI Class J was applied. And that can cause massive issues later on in things. And the DSPCA also confirmed that subject to qualification, some employees may be able to claim part-time job seekers payments or short-time work supports. So you as an employer don't have to worry too much about keeping employees on full-time. You can reduce down their hours knowing that there is these other supports out there. And the only sort of health warning I suppose to give on this is that for employees or employers looking to get bank loans, mortgages, anything like that, being on the EWSS or any of those supports can cause a headache, as banks are slow to give out loans or mortgages to anybody who's availing of these schemes. But that's just a observation on it. The big one at the moment is the CRSS. So the purpose of the CRSS is to cover day-to-day running costs that can't be deferred. So insurance, light, heat, rent. The funds received through the CRSS are used to reduce down the expenses claimed in the P&L. So there's a number of dates and operations to follow, given everything like restrictions tighten, they ease, they tighten, and it's very much aimed at hospitality and events venues, okay? And it's more for the venues rather than the people who attend the venues. So like, for example, a venue like the Gaiety, Whelan's, and the Point, they can claim CRSS, but the people who perform at those venues can't claim CRSS because it's not their venue. So unless they own the Gaiety, Whelan's, or whatever, they can't actually claim this. So it's really only for bricks and mortar buildings, okay? And when given all of the easings and restrictions, it's very important to keep full records. Claim submissions are kept, because you want to be claiming the correct amounts, but also to the fullest extent. Like there's large amounts there to be claimed. You can claim up to $5,000 depending on your figures. And there's also the restart weeks and the double restart weeks. So, you've got to keep all of that in place. Hopefully, the restrictions ease at the end of the month for everybody. And you can only do claims over a period of 3 weeks. So if you were part of the hospitality sector that did go down, well then you got 3 weeks in December, then you're going to have a period, we're going to do a reclaim from December to January, and then probably another 3-week period claim for the end of January. Your turnover has to be down 40% or less of the average weekly turnover the claim period. And then, but be careful. One person did ask a question on this, if you were newly incorporated. So if you were newly incorporated pre-26th of July 2021, what you take is the average weekly turnover from commencement up until the 26th of July, And that's what you use as your basis for your weekly turnovers, and then for you're going into your claim periods. Okay. There's a restart weeks and say also available. What else can I say about this? So the government, that it's mainly aimed at say outdoor venues. This is actually really surprising. Outdoor venues, outdoor markets still don't qualify for any of this. Businesses must operate at premises they must be located in Ireland, and that's the 26 counties. Okay. Coffee shops could operate it and only run takeaway service, but they probably won't qualify because they're not really restricting customers in there. So as I say, this is really aimed at pubs, restaurants. The turnover has actually dropped, because it used to be your turnover had to be down 75%. Now it's only down 60%, which is still substantial. So that's it. Then there's a good decision tree actually here. So are you currently claiming this? Well, then yes. Have new restrictions been announced? Well, then yes, they have. And you can reassess your eligibility under Section 2 of their manual. If you no longer qualify, check can you claim the restart weeks. And there's always, like, if you qualify, if you don't qualify, check and see, can you still qualify, or can you qualify now for a new one? I'm always saying to people, it's never any harm to ask the question. The worst they can say to you is no. You haven't lost out by asking the question. So always ask the questions. Can we claim this? If you can, happy days. If you can't, okay, it's a blow. But, at least instead of kind of going, oh, sugar, I could have, and you're now out of pocket on it. The business resumption support scheme, the BRSS, that's pretty much gone now. Okay, applications closed for that in November. So it was similar to the CRSS, but it was open to an awful lot more businesses. It's gone, so not being carried on as much, won't impact as many. The major change at the moment now has been is a debt warehousing. This has been extended. Revenue have yet to update their debt warehousing manual on this. I even checked again this morning. So they issued a press release last week to say this has been extended, and they will be updating their manuals. They haven't updated their manuals. So be careful of this debt warehousing one. It has been extended, which is great. So this was set up to help assist businesses experiencing cash flow and trading difficulties. Normal interest rates are roughly 8% or 10% per annum. And it was only available if your turnover was significantly reduced down or your customer orders were down. And you need to show revenue that you're unable to meet the payments as per normal operations, similar to what you would do with the phase payment application form. You had to show the same things. It's automatically there for small businesses. Larger enterprise businesses have to apply for it. It covers VAT, POAE, income tax, the TWSS, EWSS overpayments. Strangely enough, there's nothing there about corporation tax in there. They're probably thinking you'll have losses anyway. So there you go. I would recommend, even though you can park the debts interest-free, I would recommend chipping away at it, because even if you leave them there, they're still going to be there. Revenue aren't wiping these debts. They're just not going to apply interest for them. They're not going to send a sheriff around. So, if you can, just chip away at them. It means less amount of interest later on, less of a headache going forward. So the main dates now was period 1 was due to end on 31st December. Revenue have now extended period 1 to 31 March 2022. That covers your POAE and VAT in those periods. So all qualifying taxes are entered into the warehouse now up until the end of March this year. So period 2 was then supposed to start in January and run to December. It's now starting on the 1st of April and running through to March 2023. So during this period 2, no interest is going to be applied on any of the warehousing debt. So it's a great time to start paying it off, chipping away at it. But bear in mind, you will have your current debts also to pay. So your POAE liability for April, well, that still needs to be paid in May, and so on. So you've got to keep your current debts then up to date. So you can commence paying it off. Period 3 now then doesn't commence until the 1st of April 2023. And it's going to have a 3% interest rate applying, which, as I say, is a lot less than the 10 and 8%. And you need to supply revenue with a repayment plan. Again, very similar to the PPA. But if you can chip away during your 0% rate, you're going to have less to pay during the 3% rate. So keep an eye on them. Hopefully these will be the end of these things and there won't be that many more updates going on with them. We're hoping there's no more lockdowns. So all of these will start to ease. So employers are going to need to start looking at their cash flows coming out of this and stop relying on government supports. The other thing that businesses should do as well is actually look at their local enterprise boards and see, are there any schemes there that can help them out to with easing of the cash flows and all of that.
There's a number of questions in here, Naomi, right? I don't think we're going to get to answer them all and get out, because Sinead still has to come for her session. So I think what we're going to do, Naomi, is I'm going to get you to answer a couple of questions. I definitely want you to start with Sharon's question, because Sharon was really quick off the mark. She asked her question right very back at the start of the session. So I want you to answer Sharon's question. We'll pick a couple of others. We'll go do Sinead's session, but then anybody who's up against time, we'll get them out. We'll aim to finish up by about 25 to 1. But then what we'll do, Naomi, is we'll come back, because I think there's 7 or 8 questions here about this whole area of shutdown. So Sharon's question originally, Naomi, was, I'm just going to scroll back up to the chat to get right up to the top here. So Sharon's question was the basis of turnover to be used for a new company incorporated in 2021. The restaurant trade was previously carried out by another owner in 2019. I'm not a tax expert, but I assume that's not relevant. Would it be a requirement to obtain the 2019 figures? And then Sharon had a follow-on component to that question a little bit later. What's your answer for Sharon's question, Naomi?
So basically, if the company was newly incorporated between, and I have the dates here, the 13th of October 2020 and 26th of July 2021. It's a very random date, 26th of July, but there you go. You look at the average weekly turnover up until the 26th of July 2021, and you use that as your basis. So you don't need to look at the 2019 figures at all. You literally go with, what do I have up until date of incorporation? From then up until, or commencement, up until the 26th of July 2021. That's what you're looking at. And if it's incorporated after 26th of July, I'd go with the averages again, and they say submit the application to revenue on it and see what they come back with. But their guidance is really only up until 26th of July.
Okay, so Morris has a question here. If you're already on the EWSS from 2021, do you need to reapply?
No, if you're already still on it, it's carrying on, because you have to sort of take yourself out of it. So if you're still in it, you're fine. It's only people who took themselves out of it because with everything reopening, they no longer met the restrictions. They might need to reapply, but if you've stayed in it, you're in it.
Okay, the next question in from Padraig Smith. So maybe Sinead, you can take over the controls there and start bringing up your session. We're going to answer Padraig's question, then we're going to move to Sinead. I know other people have questions. We'll come back to them at the end. So Padraig's question is, I have a question in relation to employers who are already on the EWSS, have submitted monthly updates during the second half of 2021, have submitted their final actual figures to 31st December 2021. Do they have to complete eligibility reviews for January to April 2022? And if so, what is the comparison base period to be used? Do you have an answer for that one, Naomi? Off the top of your head.
Off the top of my head, I'm not sure the comparison, again, is going back to the same period, 2019, sort of pre-COVID, but I'll have a quick gander and I'll come back with a proper answer. Give me sort of 2 minutes.
Okay, so we're going to move to Sinead. Padraig, when we come back, Naomi, after Sinead's session, Naomi will answer that. Naomi, there's questions both in the question and answers box, and there's also some sprinkled into the chat there. So if you want to have a look at them when we come back. So Sinead, you're going to talk to us about the CRO and company law updates. The farce continues, Sinead.
Does it ever end? I feel like it hasn't ended since, was it the 16th of December when new core launched? I'm quickly going to run over company law stuff first. There's obviously been a lot of changes since December and a lot of things you need to keep your eye on for 2022. And then I'll end it with everyone's favorite topic, which is the CRO. So we'll move on first. These are the areas I want to touch on. So quickly we'll look at SCARP. We'll look at the Corporate Enforcement Authority Act, which was actually signed in December there. It has yet to have its statutory instruments put into place as of last night, but we imagine those will come up soon. We'll quickly look at the COVID Miscellaneous Act as well, that was extended till April. The Corporate Governance Gender Bill, because I'm getting a few questions in about that, and then of course some changes to core. So I'm sure everyone's familiar with SCARP now, but it's kind of really going to start to kick off, if it hasn't already, in January in Q1 this year. So it was signed in on the 22nd of July 2021, and it commenced on the 7th of December 21. So it kind of was rushed in very quickly, and thankfully as well, because the whole idea with SCARP here is that it's going to be an alternative to examinership that's cheaper and it's going to take less time. Obviously, it's available to small and micro companies, so that's nearly every company, 98% of all companies in Ireland. And the ways that they're going to save money here is it's actually commenced by resolution of the directors rather than having to go to the courts. And your company will engage a process advisor. So a process advisor is essentially going to be like a liquidator. It can't be the accountant or the auditor of the company. It's going to have to be someone qualified under the Companies Act to be a process advisor. And what happens basically is the PA is going to engage with the creditors and come up with a rescue plan, which is the best outcome for the company, in order for them to survive through SCARP and to be, I suppose, it's like a second chance really here. So it's not a third, fourth chance, it's a second chance. Like I said, it's going to be shorter than examinership. So obviously now with the COVID Miscellaneous Provisions Act 2020, you have 150 days on examinership, but SCARP here is going to hopefully be completed within the 70 days. This rescue plan as well, that we'll touch on very quickly in a second, has to satisfy the best interests of the creditors and be a better outcome really than liquidation in the end. If at any stage the directors, process advisors don't think that's at the pre-planning stage going to be possible, there's no point in even entering into the SCARP process. And a company, like I said, is going to have to show that they'll be viable following the SCARP itself. So there's a couple of different areas for SCARP. You've got the pre-planning section. I've broken all this down here where their statement of assets is drafted, a report is created by the process advisor. This is then put to the directors and a resolution is passed. Like I said, it's going to be cheaper here now than it's resolution rather than the courts. And then there's kind of a pretty nice timeline. You've got between day 2 and day 42, you have to formulate a rescue plan as the process advisor, but then the courts have to be notified within 2 days. Within 5 days, you can let the stakeholders know. Websites have to be updated within 48 hours. And the process advisor engages with creditors and stakeholders and gets all that information. The CRO have updated the form now, so it's called a SCARP 1 form. You can see it on Core if you're able to get onto Core today, because it's not possible really. And then, like I said, day 42, the process advisor is going to call a meeting, take 7 days notice for that meeting. So everything has to happen by day 49. So it's kind of a quick process, a lot to get done in that timeline. And then the creditors are going to vote. You have a 21-day cooling off period, and then by day 70, so you've got day 49 plus 21 is going to bring us to 70. If it's approved, it's going to become binding then. If it's not approved and there's objections, it goes to the court then. But I think you can see from all this, it's going to be a quick process and an awful lot cheaper than the likes of examinership, and hopefully really helpful to all these companies coming out of COVID. Everyone's kind of struggling right now. The newest act then we have in place is the Companies Corporate Enforcement Authority Act 2021. It was actually signed in on the 5th of December, but like I said, as of last night, the statutory instruments haven't come in place to change the likes of CRO forms or any details like that. These will come in quite quickly. But I suppose the big thing that you'll see in the media now is that the ODCE, as we all know it, is now going to become the Corporate Enforcement Authority, CEA. It doesn't have a great ring to it, so I think we'll probably all stick with the ODC for a little bit. It'll be just kind of stuck in our heads, but they're going to become a standalone agency now. They're going to have a huge amount more of independence, a huge amount more of control. They're going to have additional staff, they'll be able to come into offices and access computers, that kind of a thing. And this Companies Act itself is actually going to just be updated. So anywhere it says ODC is now going to become the CEA. And I suppose that's definitely something to keep an eye on. I know I've had a lot of accountants say that their clients are questioning it because they're seeing it in the media all the time. And as the different statutory instruments come through, if you join us on our monthly updates, we'll definitely be updating you as you go. And you'll notice the changes on Core for definite. Some big changes I just want to flag with the Companies Act itself then. There's some clarification around the reorganisation of capital as permitted with distributed reserves. What does that actually mean? If you're doing a share for undertaking right now, so you're swapping assets for shares, if you don't have distributed reserves to the book value, there's a bit of an argument around, do you need a SAP 204? In most cases now, a purchaser will require it. But when this comes into place where our statutory instruments and is commenced, if you book value, distributable reserves to the book value, you won't need a SAP 204 anymore. Then there's some additional points here, and I can let you look in your own time. Secretary can't be under 18. It's nice to have that clarified finally. Some clarification on mergers where it's acquired, where it sells are going to be treasury shares. Something with business letters, then you're going to have to put your director's details on the business letters. That's really important. It's the first thing a company secretary sees. I mean, I get a business letter in, if the footers aren't correct, it's immediately the first thing I think about. And then something I'll touch on in a second, and what's really important, and it's going to affect a lot of people because I think a lot of clients mightn't be too impressed with it, is that on your A1s for new directors, you're going to have to put in the PPS numbers. I'll touch on that in a second. It hasn't been updated yet, but I imagine that's coming in quickly because it seems like core is going down quite regularly now to engage all these different changes from these different acts. Then obviously the Miscellaneous COVID Provisions Act got extended to the 30th of April 2022. What does that mean? We can continue our virtual meetings as well as having hybrid and physical AGMs. Documents that are required to be executed under seal can be done on counterparts, so very handy. And then you've just got kind of changes to the likes of examinership and statutory demand for increased amounts from 10, 20k to 50k. What's most important here though is that there's obviously going to be provisions for the minister to actually bring in virtual meetings permanently into the Companies Act 2014. It's not in place now unless it's in your constitution. Hopefully that will be in place before the 30th of April 2022. I'm not 100% convinced it will be. So if you have any AGMs or EGMs coming up now, or written resolutions you can pass as well, if it's applicable to you, definitely maybe put in a clause in your constitution to allow for virtual meetings. I think they're here to stay. I don't think we'll ever go back to fully physical general meetings going forward. So just might be handy to keep that in mind. The Irish Corporate Governance Gender Balance Bill 2021 then. It's only at the stage, second stage of the DOL, so it's a baby bill essentially, and it does have an awful lot of exemptions. But what's happening is it's going to increase the number of female board members over a 3-year period. So it'll have 33% of board members from year 1 of enactment will have to be female, and then that will be 40% by year 3. Like I said, there is the exemptions. You have single director companies are exempt, companies with less than 750 million in turnover, less than 20 employees, unincorporated entities obviously and partnerships won't be included, but there will be likely in the form in your annual return B1, you'll probably have to include this compliance section here, whether you're complying or not, and if you're not complying, as to why. And there is some penalties that may be available currently, and this is just in the drafting of the bill right now. Obviously that can change, it can go everywhere, it could take years to come in, or it can come in very quickly. So just keep that on the radar. It's in the back of your mind, but it is there. Now my favorite topic obviously, which is core. I'm sure everyone is familiar right now, and if you haven't already, on Twitter today the CRO said that there has been intermittent issues with access to core recently. Obviously we all know recently means November, if not like November 20, if not December 19. That's obviously just very disappointing to have them not acknowledge that there is an issue with core right now. I know myself, I was an hour and a half trying to get on core alone today. RBO yesterday for me was an hour to get on, and it's obviously causing huge delays if you don't have the software packages and you're using core only. And I think all these changes are coming in line because a lot of CRO forms that we now use manually are going to be moved to online forms only. So the main ones that they're flagging right now are essentially the liquidation forms. So you've got your E3, E4. I see benefits to this. Obviously, liquidation documents have strict deadlines that they have to go into the CRO on, and rather than posting it in, it is going to be better to upload that onto the system. Unfortunately, and I'm sure as we all know, uploading documents to the core does not necessarily mean it is uploaded and submitted status. Sometimes something happens and it flags back to the payment section, or it's returned, or it's as if you never submitted it at all and stays in the signature page. So while there are benefits here, and I'm sure everyone who's used to me talking is familiar with me saying this, please continuously check your returned, rejected, signature section and your draft section, just in case some document that you're uploading didn't go through. And like I said, there's no statutory instrument taking this into place yet, but if you keep up to date with this on our monthly update webinars, I'll flag these as they come through. Obviously the A1 will be changing then soon to include a PPS number for your directors, and most likely as you will have PPS numbers if you're filing agent, and you'll have it from the RBO as well, but that will have to come into place on your A1 now, and if you do your formations with us as well, we will be requiring that PPS number for when this comes into place on a statutory instrument. And then finally, this is actually a big concern for me right now. Can an online form be rejected right now? So this is a question I've been getting lately. It's because if you submitted a B1 late and it was in submitted stage or received stage, as we know it now. You can't ring the CRO and ask them to reject it for you, because they're saying, I think it's under section 898, that unless there is an again, non-compliance factor, so let's say someone missed a signature on the B1, that they can't actually reject that B1. It's only into return stage. So let's say you were late on an annual return, you didn't know about the section 343 application to extend your annual return to the district court, so you don't have to do late fees or don't do late or don't have to do your auditing. You used to be able to ring the CRO and say, well, it's only in receive stage, can you please reject it for me? And then in that case, you can seek the section 343 application. The CRO now are saying you will have to, unless it's non-compliant, so like one signature, for example, you will actually have to correct that B1 no matter what. They will not reject it back to you, which is really disappointing. And there was no update to that. I kind of found it out from poking and prodding with the CRO. So in your B1s now, if you think you're going to be late with section 3 and you're late with your annual return, just under no circumstances file. Please ring me and my team and we can seek the section 343 application, because gone are the days now where if you submitted it, they're just going to reject it back to you. So that's my very quick update. But like I said, we'll update all these because these will all change as they go, and we'll be updating these on our monthly update webinars.
Okay, so there's lots of questions. No offense, Lindsay and Colin, but your sessions must have been very boring, because Naomi and Sinead's session is absolutely hopping here with questions. So what we're going to do is we're going to answer some of Sinead's questions, then we're going to go back to Naomi. But for anybody who's rushing off, right? So the first thing is, this is the first of a 3-part free CPD series. You get your 3 free-hour CPD. The next session is the 18th of January. 11:30 to 12:30 again, and this is the welfare state pension qualification update with Brendan Casey. Brendan is not internal team, he's one of our external experts, former revenue. The guy is a PRSI genius. And our final session in the 3-part series is the 20th of January, again 11:30 to 12:30, dealing with customs in a post-Brexit trading environment. For that session, we're going to have 2 category authorities, Martin Agnew and Kieran McGonigal from AB Consulting. Now, looking at these questions and how this is lit up, I know this is supposed to be a 3-part series, but I'm actually thinking we might run a 4th part, because there seems to be a huge amount of questions around the wage subsidy scheme. Anybody who has questions today that haven't got answered, or you have questions, Naomi is going to kill me now, but the last person in has this honor when I do shit like this on webinars, which I'm not supposed to. If you have questions that have not been answered today that we didn't get to, now we're going to stay here for another 10 or 15 minutes for anybody who can, but if you have questions that we didn't get to answer, if you email Naomi nbutler@omnipro.ie, either Naomi will answer the question for you, or if it relates to Lindsay, Colin, Sinead, she'll be the conduit, and we want everybody's questions to be answered here today. Sinead, you were talking about 343s, and there's a question in here all the way back from, whoa, where's it gone now? There's been a number of questions that have come in since then. From JP, Sinead, the length of time it takes to go through the section 343 process is making it completely irrelevant as a solution to late filing, due to waiting for a court date.
I would disagree on that. You will never miss an annual return with the section 343. So let's say you were to apply for an annual return for your 2020 annual return date. And look, with delays with court and COVID, it's not going to be till maybe May 2022. But we'll include the annual return for 20, 21 and 22. So you won't be late on any annual return there. You won't have any late fees and auditing. And once I think that's explained to your client, I think they will understand. And the CRO themselves understand that as well, like communication I've had with them. They understand that, look, there is just delays with the courts right now. Whereas your solicitor and your barrister will include every annual return date that's necessary.
Okay, so there's a question in here, Sinead, about B67s and the Section 140 certificate. Mm-hmm. And you can see there, it's a 2-part question. So we filed the form B67 to the CRO, and the status on the CRO only stated as submitted. And can you advise, is there an actual Section 140 certificate to be issued by the CRO? And the second part of this question is, the B1 needs the Section 140 certificate to file the annual return, where there's no EEA resident directors on board. So how long do we have to wait before we file the B1? And do you have any examples, Sinead, of what a Section 140 cert looks like?
So your section 140 start from revenue is going to be attached and sent to the CRO, or to the, well, it's called an old section 140, will be attached and sent to the CRO. That's a CRO error. That's nothing else. That is just because they haven't hit from submitted to registered, and that will take off. So the B1 form can only work on what registered documents are on, like if you look on Vision or search for less. So in that case, you actually just have to ring the CRO and say, get through to the relevant department. And usually I would recommend in this case, ring EB1 and tell them, because this form B67 hasn't been registered, it's in submitted stage, I can't file my B1. So just ring or email. I would recommend rings, sometimes a little bit quicker. Ring them and just say, please register this document. That's all you have to do. It's just they're so backlogged and delayed with when a document gets from submitted to registered. For example, I have a G1 that is in submit status since January 20. So keep that in mind.
Okay, so just a couple of questions for Sinead, then we're going to come back to you, Naomi, then we might have a couple to finish off on Sinead. So Paddy's question here, what happens of a director if a director is foreign, either EU or non-EU, with no PPS number, in terms of your comments on incorporation, Sinead?
We don't know yet. That's the bad answer, unfortunately. They'll either go down two routes. They'll go down the RBO route, which is most likely that you'll have to fill in the equivalent of a B Ben 2 form, and where it'll be just, you'll fill out the details of the person and it'll be notarized or signed off by a solicitor or barrister. Or they could go down the route that Revenue have done with the beneficial ownerships of trust, where as long as you have an equivalent passport number or foreign identification number from whatever country they're in, that number can be used. Yet to see, since the CRO and the RBO are not connected, I would imagine it'll be the likes of the Ben 2 form.
Okay, so hopefully, Paddy, that answers your question. I'm also hoping that it answers Emma's question and Robin's question, that all three of them really are about not having PPS numbers and A1s. Just there, Morris has a tip. I don't know whether you concur with this or not, Sinead. Morris is saying that when Core is having problems, that he finds it works better with Internet Explorer and browsers. Do you have is that your experience, Sinead, or is that just Morris is getting lucky?
No, I find Internet Explorer and Edge actually to be the best, and I can't do anything with Firefox or Chrome.
Okay. And then, Brian, are our institutes challenging the CRO on Core? Is there a case for blanket exemption for SME from an audit due to late filing? Brian, of course there is. I tell you what, Brian, if you really want to annoy yourself and upset yourself, you should go onto the CRO website. You should download the minutes from the CRO forum meeting with the institutes from 2021. It is a joke. It is a total joke what's going on up there. I don't know what is happening with the CRO. I don't know what halo exists over Maureen O'Sullivan's head, because this woman walks on water to preside over the debacle that is the CRO and Core. It beggars belief. It makes Boris Johnson look like a saint. What party? What do you mean a party? Oh no, we have to wait for the inquiry for me to work out whether there's a party or not. It's just beyond belief. I don't know, Brian. I don't know what to do. I was speaking to a politician recently about this. I said, how does this work? Like, how can there be departments in the government who operate so inefficiently and so ineffective? And the politician's just shaking, just going, I don't know. He said to me, why don't you do one of your petitions? It worked the last time. Why don't you do a strike? It worked the last time. I don't know. Maybe we will. I've kept my mouth shut for long enough on this. I don't know what we're going to be doing. Okay. Jonathan has just put into the chat box, by the way, the Sinead should not be recommending the use of Internet Explorer, because obviously Internet Explorer went out with the Ark, but only the CRO could develop a product that would work on an Explorer that's no longer hosted, that's no longer secure. Okay, so we had a question in from Padraig Smith. Back to you, Naomi. Question in relation to employers who are already on the wage subsidy scheme. They've submitted monthly updates during the second half of 2021. They've submitted their final actual figures to 31st of December 2021. Do they have to complete eligibility reviews for January to April 2022? And if so, what is the comparison base period to be used?
Basically, what I can find is there's no mention of eligibility reviews for 2022, right? However, revenue being revenue, I wouldn't just sort of ignore it. Rolling monthly basis. So go with what you projected against it. Actually, I'm going to look around and see if I can find any more. The revenue were on top of updating their manuals. Like every time they issued something, they've gotten a little bit slow. So I'm going to have a dig around. I've made a note of the question just to be sure. But at the moment, all I can find is rolling monthly basis. So what you projected it was going to be, what it actually was. If it's still low down, especially compared to 2019, I'd say stay on it. You know, you kind of have a good idea yourself, especially if you're in the entertainment sector, the hospitality sector. You're definitely down. You definitely qualify. Other businesses, yeah, it's going to be comparisons rolling against projected the whole time. But
okay, so Naomi can't answer that one definitively right now, Padraig. And as I said to you at the start, we live, breathe, and sleep this stuff, and we can't answer questions. How can you guys be expected to do it? If you could email nbutler@omnipro.ie, Naomi will take a look. So the next question is in here from Claire Fitzgerald. If you're eligible for EWSS at 31st of December and claim same up until this date, is there further criteria? So that's the same question. It really hasn't been issued.
It hasn't been issued. Again, if you're still claiming at 31 December, chances of your income shooting up in January this year, probably not. You know, sales for most people in January always go down anyway. So I'd stay on it. But yeah, for those two, I have it here as being the same question. So I'm going to have a dig around and see if I can pull up.
Well, here's breaking news, folks. Breaking news. So Rita, and this is what I love about being part of the OmniPro community, because it's not just about us answering the questions. It's actually when we work with you guys, you're giving us the answers and then we're sharing them. So Rita has shared an insight here. Rita was told by Revenue this week that if you were eligible for EWSS at 31st of December 2021, well, then there's no further eligibility reviews required. So obviously give a call. They're probably going to issue an update on this, Naomi, as you say. Naomi's going to look into it. Avril's question, Naomi, is there a deadline to claim the CRSS?
So when you're claiming CRSS, you're supposed to do it no later than 8 weeks after the date in which the claim period commenced. So for the hospitality sector, I'm really bad. I don't drink, so I'm really bad when the pubs shut. I think the pub shut on the 1st December. So you've got 8 weeks from that date to make a claim for CRSS, which would probably bring you in around this week, around the 15th of January as well. So you do have 8 weeks from the date the restrictions came into place to make a claim for CRSS. So I would say get it in this week, definitely.
Excellent. The question in from Adele. If you were claiming EWSS, do you have to claim for all employees that qualify, or can you be selective and just claim for certain employees? Client has one employee. He does not want to claim even though she qualifies based on wages.
Yeah, so this is very unlike the TWSS. TWSS, you could have picked and choose which employees you put it on because you were changing their PRSI class from A1 to J1, for example, right? In this instance, you're not changing the PRSI classes. You submit the payroll as normal, and Revenue then give you credits for the PRSI, and then they give you back the EWSS amounts. So you can't really pick and choose. I kind of get maybe the reason why this could be is that that particular employee maybe wants to go for a mortgage and doesn't want to be seen to receiving any benefits. It's not like the TWSS. It doesn't happen. They're just going to see. Some they're saying you can't pick and choose in the payroll. Yeah, fair enough. Again, it says the same there. The system software. So I suppose it depends on your system software whether or not you're ticking the box for EWSS on it. But again, Revenue websites on this one have it not updating. But yeah, if you can on the software package, great.
Well, it depends on the software provider. We can't always rely on the software provider.
Yeah. Absolutely.
Question in from Cahill, are we providing a recording of this webinar? Well, I suppose what we had said was just for us tracking it, that the CPD credits came with the people attending live. We've already seen from this session that there's a flood of questions here about CRSS. There's a flood of questions about CRO. We might run a bonus webinar. Look, I can't make any promises that the recordings will be available, but I'll talk to JR and the tech team to see if we can make the recordings available, Cahill. But right now, we can't be sure. So there's
just one question I had. There was one question I just want a quick answer to. It was about the childcare businesses and the turnover didn't drop, and can revenue claw back the EWSS. Childcare businesses didn't have to meet. This is one I can definitely answer. Did not have to meet the turnover drops in order to claim any of these support schemes.
Okay. Okay, so look, we're running way over here, and we're running way over here. Anybody that has questions that Naomi or Sinead did not get to, if they didn't get to them, email nbutler@omnipro.ie. There's Naomi, there's Lisa, there's John, who all work in the area of tax. We've got Sinead, we've got Emma, we've got Lauren, we've got John helping from a tax perspective. So we've got lots of people around the building here to help answer your questions. If your question has not been answered on this session, please email it to Naomi and we will get back to you as soon as humanly possible. Way over. But this is the thing. Life is not, it's not straight lines. Like you guys, stuff is happening. I can't believe there's so much things happening and so many problems, and it's only the 13th of January. But that's what CPD is about. That's what our CPD, that's what CPD Store is about. That's what CPD Club is about. What we're trying to do is we're trying to take CPD and not have it as something that you do at the end of the year where you just go tick boxes. No offense to anybody who was one of our customers. We love all our customers. But it always fascinates me on the 31st of December when I see people doing CPD, buying CPD courses at 10 o'clock on New Year's Eve. What we're trying to do is we're trying to turn CPD into a knowledge base, CPD into a resource that you use. And that's why CPD Club gives you all you can eat. Like I said at the very start, 100 webinars this year and 32 days of conferences, which 8 by 32 gives you another 240 hours. We're going to produce around 400 hours of education this year on various topics. Not everything suits you. The auditors on today's session, they need to do the auditing. The financial reporting people. Some of you love the CRO, some of you love the tax. This is about having access to knowledge. It's not about ticking a box to say, yeah, I've done my CPD. So thank you very much for joining us here today. Thank you very much to the team for delivering a session. Thank you very much to Daniel and the technical team and the marketing team for getting you all here. Thank you very much. We shall see you on the second part of this session. Cathal, if you want to know about recordings, we're going to try and do that. But the most important thing is, forward the link to today's session and get your colleagues on for next Tuesday and Thursday. Get them on. If there's going to be recordings, then we'll be able to let everybody know who's attended and to make the recordings available to them. So thank you very much, folks. Let's keep it lit.